breaking this down into the two components that move high yield, namely credit and interest rates. First, with credit, with the market having significantly rallied since the spring lows, on one hand, there is still room for some sectors like leisure, transportation, and energy to tighten their spreads as COVID gets under control. On the other hand, 2021 should see still somewhat elevated defaults, despite the fact that many companies that would have otherwise defaulted will manage to stay afloat thanks to the massive volume of high yield debt issuance that occurred this year and plugged many cash shortfalls. It is likely fair to assume that there is somewhat limited upside in credit spreads from here, though we could still see further tightening as portions of the market finish recovering. With respect to interest rates now, given the expectation for continued US Fed action, it seems likely that rates will remain low in 2021, though I would note that the back end has seen rising yields in recent months. A reasonable base case would assume that the high yield market will return roughly low to mid-single digits in 2021. This outlook assumes that the COVID vaccines, which so far appear to be promising, will enable a return closer to normality sometime in the second half of 2021, and that the US economy continues to receive adequate stimulus between now and then. First, we'll be on the lookout for continued adequate stimulus to keep the economy afloat. Obviously, lack of stimulus could delay the recovery. Secondly, following the US presidential election, we'll be closely watching how policies and regulations under the new administration will affect various industries like energy, healthcare, or telecom. Thirdly, interest rates are low today and likely will remain low in 2021, but unexpected moves in the yield curve are always possible, especially on the long end of the curve. And lastly, as always, there are unknowns. Of course, we saw that in 2020 with the global health crisis, which was unexpected. Starting with energy. Energy has seen a number of financial restructurings this year and will likely continue to do so in 2021, with capital structures equitized and bondholders now in a position to capture future upside. Now, this sector will require some patience as the surplus in oil inventory will need to be worked through. Moving on to transportation, airlines will likely take a little bit longer to recover in the next 12 months as global air traffic slowly resumes, at least as measured by passenger count. But certain subsectors like aircraft lessors could see their spreads tighten in 2021 as the number of flights returns to historical levels and the spread of widespread airline bankruptcies around the world recedes. Lastly, with respect to leisure, cruise lines remain highly exposed to timing of COVID resolution, but appear to have reasonable liquidity in the next 12 months and adequate collateral value. Within gaming, a number of casinos have adequate liquidity runway to withstand periodic shutdowns in the coming months. And within that gaming group, regional players are less exposed than Vegas-centric players, which are more dependent on tourist traffic. In conclusion, while each of these sectors presents its own specific challenges, we do see material upside in certain industry pockets.